There we go. So if I invest $10,000 a day at 8%, what will it be worth in 9 years? And so we say, okay, well, what would that be worth in 9 years? We plug in the formula. Again, it's the inputs and the outputs, not can you do the math. So $10,000, we're assuming 8%. Number of compounding periods, 9 years. We plug that in and we say, boom, you would have $19,990.05. Again, not going to make you do the math because they're giving you a simple function calculator. What we will ask you to recognize is what are the inputs? How much we have today? What is the assumed interest rate? And what is the time horizon? How long to get there? So present value. This determines the amount we would need to invest today to have a specified number in the future given an assumed rate of return, right? So now we're kind of going the opposite direction. We're saying, okay, let's figure out what the present value today of some future sum is. And again, it's the inputs and the outputs. Again, you're getting a simple function calculator. So, I would tell you don't overdose on the math, but here's an example. Customer says, Dean, if I have $25,000, I need $25,000 in 12 years. I get a 6% rate of return. How much would I have to invest today to reach that goal? You can see where this would come into play, perhaps in like a college education funding, something like that. And it's, again, recognizing the inputs and the outputs, right? So our future value here is 25 grand. Our interest rate is 6%. And how much do we have to, number of discounting periods with 12 years, plug in the formula, and that's what that is worth today, present value. Now, you had asked about net present value, and what we're going to do is see if perhaps we can find a free lunch, perhaps on a bond that we can buy at something less than its net present value. Rule of 72 is just a trick to figure out how long it takes to double money. So, if it's, we're trying to figure out 72 by the percentage, 12, it would take 6 years to double the money. And if it's 72 and we have 12 years, then it would be 6%. So just a nice cocktail party trick. You might actually see that on your exam as something you have to deal with. And so again, if we just take 72 and we divide by 4%, or 72 divide by 4, 18 years. If we're trying to double our money in 3 years, 72 divided by 3, we need 24%. Now, sometimes that can be a good hack when you're getting asked about questions. Like you say, man, can I use the rule of 72 perhaps to figure this out? Here's another example where we're trying to double 10 to 20. If we get 8%, boom, that's how long it would take us to double that money. So net discounted cash flow is this idea of how much today would I be willing to pay for a future set of income streams. On a bond, as we said, that would be the interest payments. On a stock, that would be the dividends, right? So here we talk about duration and how is discounted cash flow used to value the investment. Now, I'm not going to go over all of this because the question somebody asked was about net present value. And so I'm just going to go to net present value and show you an example of that and how we would use this to answer a question about a bond. So boom, 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 boom. I'm just getting to the part where we have. So here's an example of a bond. And we have, again, you're not going to have to do the math here, but we have a net present value of $925.62. So now what we're going to be asked on the test is this a good value? Is this bond overvalued or undervalued? Based on its net present value. So if the net present value is $925.62 and we can get it for less than that, that's going to be a good value. And if we have to pay more for that, it's not going to be a good value, right? So the cost of the bond is $921.25. The present value is $925.62. And so it has a positive net present value. And that means on the test, we say, yeah, this is a good value. So that's how you're going to get asked about net present value. If we don't have to do it. We just have to know whether it's positive or negative, right? Nobody's going to make you come up with that $925.62. It's going to be given. So they'll say the net present value of a bond is $925.62. It's trading in the secondary market at, it's trading in the secondary market at 92 7/8. Again, that has a negative. You have to turn the 7/8 into dollars, but that's negative, and we would say that would be overvalued or not a good value, right? So That's how we're going to ask you to do this idea of net present value. I think the next thing that somebody wanted to talk about, let me just check chat, was total return. Digital assets, I think I've talked about that already. I said digital assets, I've seen people make videos that are just completely off topic in terms of what you're tested on. What you're being tested on digital asset, is it a security? And if so, then it needs to be registered. I found out that my favorite story here of late was not true. I'm such a true believer, so I'm always disappointed when I find out what I thought was a great story. But the story was Taylor Swift was offered a bunch of cryptocurrency to be a promoter. And that the story I heard, and I've had it corrected since, but that Taylor Swift asked before she said yes, can you assure me that this cryptocurrency isn't an unregistered security? Wow. For Taylor Swift, I thought, man, she's really kind of sophisticated. We'll come to find out her manager said it didn't quite go down that way. But oh well, hell of a story. But that's the right point, right? The point is, are you offering an investment opportunity in a digital asset? Because if you're offering an investment opportunity in a digital asset, and how many people are? Lots. And the North American Security Administrators and the SEC think, well, then if that's what you're offering is not a medium of exchange, right? Bitcoin is a medium of exchange. It's a currency. It's not an investment opportunity. But if you're offering cryptocurrencies as investment opportunities, then the security needs to be registered. And then once it's a security, that means the people who are trading it have to be registered in exchange. So that is the test issue about digital assets. The test issue is the digital asset a security? And by the way, how do you figure that out? Remember this? Is it a piece of paper that can be traded to a third party for a profit or loss? Is it an investment opportunity? If so, it needs to be registered. Total return, I think we've talked about that a gazillion times. I'll do it again. Total return. Let me get a whiteboard. I even made a little video on this saying there's only two ways to make money. The only two ways to make money are how. You remember how you make money? The only two ways you make money in investment is income stream and or price appreciation. That's how you make money. Those two things together are called total return. So let's just try one. Do stocks have an income stream? Do stocks have an income stream? Yes or no? Do stocks have an income stream? Yeah, I'll go over variable annuities next. Anybody want to answer me in the chat?
Would that be like dividends?
Yeah. So my question is, do stocks have an income stream? I'm being a jerk, Crystal. Some do and some don't. So Crystal, if you buy a stock with no dividend, how is the only way you can make money in a stock that has no dividend? Is to sell it to someone else for more than you originally paid. By the way, if you sell it for less, now in a stock with a dividend, there are two ways to make money, right? You can make money from the dividend, and you can also make money from the stock going up. So Bank of America, for example, pays an 84-cent dividend annually. So if you own Bank of America stock, you're going to make some money from the dividend of 84 cents. And then hopefully you would also hope to make money from the stock going what? Up, right? So there's two ways you can make money. You can make money from that annual dividend, and then hopefully you can make money from price appreciation. Do bonds have income streams? Do bonds have income streams? Yeah, they do, right? The semi-annual interest. So you can make money from the annual interest in a bond, And then you might be able to sell the bond for more than you paid for it. Probably not today in a rising interest rate environment, but hey, right? So let's say I bought the Bank of America stock for $25. Cost basis is simply when I turn the money into the stock, right? And let's say that now Bank of America is $30 a share. So it looks like I've made money a couple places here, right? I've made 84 cents in the dividend, right? And I made another $5 from the stock appreciation, right? That's price appreciation. And so my total return has been $5.84. Now, by the way, you got to be a little careful here, Erica, because if this said I own the Bank of America stock for 2 years, right, then I would have made $1.68 there, right? I'd have to times that by however many years they told me, because I would have got that 84 cents each year. Now, to answer the percentage return, we always do percent means divide. So I always say on any of these exams, if you can't decide what to do, you should divide. And if you can't remember what to divide, take the first number and divide it by the second number. Right. So, that takes care of 90% of the math. So here I made 584. And I spent $25 to do that. And so now I'm just going to take my calculator. And 584 divided by 25, my total return on the Bank of America stock has been 23%. 23.36%. Any questions on that? Was it you, Erica, who asked that? That's the total return. By the way, not bad. Mr. Buffett owns 1 billion shares of Bank of America. 1 billion shares of Bank of America. So that means you're getting 840 million a year in dividend income. 84, everybody gets 84 cents a share, but when you have 1 billion shares, it's a little more exciting. And when they were asking about what he likes about his Bank of America stock, he said, I like my Bank of America stock because I have a nice opportunity for total return. I get a nice dividend, and I'm hoping the stock will also go what? Will go up. It's not as exciting as a growth stock, but hey, not as risky as either, right? Not as risky as some other investments. Any question on that one?
Hey, Dean, my trouble with this total return is when they give you 3 different scenarios and then you have to calculate that all at once. That's my trouble.
Well, as I told you, so what you got to do is you just got to, if they say you've had it for 3 years, I just warned you about that, right? So they said you had that for 3 years. That means you made an income stream from the Bank of America, 84 cents times 3. You made $2.52. Right. So you just got to go through that time frame and say, okay, well, how many dividend payments have I collected? Versus, and how much is the price appreciation, right? So now we would do the math again, right? So let's just do the same question again, right? So now it says your client bought Bank of America stock for $25 a share. It has an 84-cent dividend. He's held it for 3 years. The stock is now 30. Well, now we're going to say, okay, we got 252 from the income stream. We still made $5 in price appreciation. And so now our total return is $7.52. Right? Boom. Boop, boop. And then again, we would do the math. And we take 752 and we divide by 25. And now our total return is 30%. Right? Because I'm taking that and I'm dividing. Now, one other point, Erica, maybe this is what you're struggling with. Now I might ask you, what's the annualized return? Right? So we've done divide that by 25. And now that, remember, isn't an annualized return because we held the Bank of America stock for how long?
3 years.
So now we would divide the 30% by the 3 years, and we would say that the annualized return was 10% a year. Right? I'm going to divide that by the 3 years. So maybe that's where you're struggling a little bit when they ask you, you know, what is the annualized return? But again, you can always send me the, you know, the question and I can show you the math again. But, you know, total return is testable. To be honest with you, total return, I think it was Claudia that asked earlier about net present value. Or was it Kathy or somebody? I think it's more likely you get total return than you get, you know, Kathy, the net present value stuff. I think those are good scores. I think those are good scores. So you just got to keep working. I know you're a grinder, so just keep grinding. All right. So anything else? Let's see. We got annuities. All right. Variable annuities. Variable annuities are on all tests. And one thing you need to know about variable annuities are you using pre-tax or after-tax money? Pre-tax or after-tax money when you buy an annuity? Pre-tax or after-tax?
Pre-tax.
No, not pre-tax. It's post-tax. It's money you've already paid taxes on. So if I'm talking about investing in a variable annuity, you say, Dean, I have maxed out all of my other retirement plans. I have maxed out all of my other retirement plans, all of the money that I can put in pre-tax, money before I pay taxes that lower my adjusted gross income, right? So let's say Dean makes 100 grand. And let's say I put into my 401k 22.5. Wow, I just lowered my taxable income from $100,000 in taxable income. And I put 22.5 into my 401k. Now my taxable income is 77.5. Wow. And that means I've never paid taxes on the 22.5 that I put into my 401k. Or let's say Dean makes 100,000 and I fund my IRA for $7,500. I've now lowered my taxable income down to 92.5. Now that's kind of nifty, but that means that any money coming out of that has never had taxes paid on it. So everything coming out is going to be taxable. I have a zero cost basis, All right. So that means if you're going to give me a fund a variable annuity, that means you shouldn't fund this until you've done all your other things. And so now we're going to put $100,000 into this variable annuity. And that's money you've already paid taxes on. Right. So this is going to be your cost basis in your retirement plan, regular retirement plan. There is no cost basis, but here it is. Remember, cost basis simply when you turn the money into the investment, you took $100,000 you've already paid taxes on, you put it into a variable annuity. And then what we're going to do with this $100,000 is we're going to put it in a separate account, which is a mutual fund, a separate account, or sometimes referred to as the sub account, which is a mutual fund. And so that means very testable, you have investment risk, right? Because you have a proportionate ownership in a portfolio of securities. And we would pick a separate account that kind of hopefully matches your investment objective. Now, since this is in this variable annuity and you can't get your money out of here, this money is going to grow tax deferred. So you don't owe taxes until you go to get this money out of here. And so just like any other retirement plan we'd be talking about, by the way, we refer to this as a non-qualified retirement plan. Non-qualified meaning, again, you're using money after tax. Qualified means you're using pre-tax money. So we refer to this as a non-qualified retirement plan. And just like any other retirement plan, you can't get the money until you're what age? You can't get the money
59 and a half.
That's right. So at 59 and a half, you can get this money. Let's say over the time frame here, this money has grown. This mutual fund has grown, and now you have $1 million in there. And remember that $1 million sitting there, none of that money has yet had taxes paid on it. And so now let's say you're 15.5, or you're not, by the way, and you get money out of this thing, then you're going to have to pay ordinary income tax rates and a 10% penalty. So there's a lot of ways you can get the money out of this thing. So now you're saying, Dean, I would like to withdraw some money. I say, well, what do you want to do? You say, well, Dean, send me the $1 million that I've already paid taxes on. So when you do a random withdrawal, I say, no. Very testable. It's LIFO. Last money's in, our first money's out. So if I send you $1 million, or excuse me, $100,000, I'm not sending you the 100 you already paid taxes on. I'm sending you 100 of the 900 you have not paid taxes on. So that is testable to know that if you do a random distribution, random withdrawal, it's going to be LIFO. Last money's in, our first money's out. All right. So another thing you can do, pretty nifty, is you can annuitize. That means you can turn this into an income stream. And you know that you can't outlive. That's kind of cool. And you say, Dean, what will give me the largest monthly payment? Test question. Life only gives you the largest monthly payment. If you tell the insurance company that you just want to be paid for your life and your life only, that will give you the largest payment. And you say, Dean, I want to annuitize. I say, cool. I say, so now you're going to get a monthly check from the insurance company. I say, when you get your first check, give me a call. Give me a call. I say, why? Because I want to explain it to you. So you call me, you say, hey, Dean, I got $1,000. I said, okay, well, let's talk about that $1,000. Of that $1,000, 10% is money you already paid taxes on. Right? Because here is where we had 100,000. Now you have $1 million. And so remember, 10%, 100 over 10, $1 million, means you don't owe taxes on 100 of the $1,000 we sent you, because that's a return of your own money coming back to you. What you owe taxes on is the $900 of that monthly check. That is taxable because that's money you've never paid taxes on. And he said, well, geez, I don't know why you wanted me to call you based on that. I said, well, I also got to tell you that now that you've annuitized, that check is going to be going up or down. You know, your monthly check is going to be going up or down, test question, based on the assumed interest rate. Based on the assumed interest rate. You know, again, I don't want to cloud your mind, but, you know, if it's 4%, and we get better than 4%, the check goes up. If we get less than 4%, the check goes down. We're not going to bounce you all over the place, but, you know, next month you get 1,010. I go, we did better than 4. You know, we get a 990. That means we got less than 4. All right. So that's a nice overview of variable annuities. I have a very good lecture on variable annuities, an entire video on this. So I suggest you go, by the way, if you go to the search bar on the channel, you can just put variable annuities and it'll come up. Any video you're looking for, any content you're looking for, you can just put it up. You could put NPV in there, for example, and anything where I discuss net present value on the channel will come up. All right. So let's see what else we got. So SMA, I wouldn't overdose on margin, Lindsay. I wouldn't overdose on margin, but we certainly can go over that. So if you're going to do well on margin, you got to know the classical margin equation. Again, I have an entire lecture on it, you know, put in margin. I've got 2, 3, 4 lectures on margin that will come up. But if you buy 1,000 shares at 40, test for phraseology would be, and you make the required deposit. And you make the required deposit. So you would say, okay, well, if it's a margin account, I'm going to have $40,000 in long market value. The required deposit that I'm going to have to put up of that is $20,000. That's my equity. I got to put up 50%. So says the Federal Reserve Board. The Federal Reserve Board says the customers initially have to be at risk for 50%. And then we can loan you, the broker dealer can loan you $20,000. That's called your debit balance, and that's what you owe the brokerage firm. And this is very testable. This is called the classical margin equation. And you should definitely know the classical margin equation. Long market value minus debit equals equity. And now they say the stock goes to 50. Now what we're going to do is what's called a mark to market. A mark to market. As we said, if you're going to do well on this, you got to be able to do the initial setup and then the mark to market. So let's just put that here. And so now we're going to do a mark. And so now you have $50,000 in long market value. You know, by the way, you should be happy here. You should be happy because the stock is going up. That's a wonderful thing. You still owe the brokerage firm. I think the best analogy is a house, right? When the market value of your house goes up, your mortgage doesn't go up. What goes up is the equity that you have in the house. And so now you have $30,000 in equity. Equity always represents what you would have if you sold the securities and paid off the loan. Nobody's suggesting you do that. And so now you have $30,000 in equity. By the way, if you close the account, you would walk away with 30, you spend 20, you made 10. You know, the person in their cash account also made $10,000, but they put up 40 to make 10, and you only put up 20 to make 10. You're making money twice as fast. Twice as fast. All right, so what I like to do, I love to lend people money. So now what I'm going to do is say, well, can I lend you some more money? So what I'm going to do is compare what you have to Reg T to see if perhaps we can't loan you more money. So half of 50,000 is 25. I say, hey, listen, you only need to be at risk for $25,000 and you're at risk for 30. You have excess equity. You have more equity in this account than you need. And you say, well, Dean, when I have excess equity in my house, my bank will lend me more money. They'll give me an excess equity line of credit. And I say, we too are willing to give you an excess equity line of credit. And so right now you have $5,000 in excess equity. And you can have that as cash, or you could use that to buy additional securities. My favorite would be buy additional securities. You say, do I have to do something today? I said, well, if you had to do something today, you might use this in a way that's not in your best interest. So I'll tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. And you can have that as cash, or you can use it to buy additional securities. 2,000, 2 times your SMA is what's called your buying power. Your buying power. Right, so we've got 5,000 you can have as cash, or 10,000 would be your buying power. Again, I wouldn't spend a lot of time on this. It's not a target-rich environment. I just had somebody this weekend, and they told me that they were going to review on the weekend margin and options. I said, well, please don't review margin. Spend that time on options. Options are much more likely something you're going to get tested on than is SMA. Maybe 3 or 4 margin questions on Series 7.
I actually had about 12 on the test that I took, so I'm hoping that I got all of the margin questions out
Wow,
of
that's
the way
crazy.
already.
Well, that's crazy. That's a death draw for sure. Face a death draw. You're Lindsay, the first person in years that told me they had 12 margin questions. I believe you. Boy, that's a draw from hell for sure.
It was.
We have a margin department that does this stuff. So, I would tell you, I wouldn't count on getting another 12. So if there are other issues, I would work on your other issues, resolve those first, bring those to par. And once you got those other things to par, then maybe turn to on margin. Now, that being said, anything else you want to know about this SMA? Did you figure out how I got that?
No, honestly, the hard part that I was having was when it went up to 50, remembering that Reg T was the 50% of the 50, not the 50% of the 40.
That's right. That's right. You got to make sure, whenever you're doing like accounting like this, because sometimes they ask you like the effects of, I could ask you like this. If I really, again, this would be a judgment question, but if you can put numbers to it, it makes it easier. But I could say something like your customer buys 1,000 shares buys 1,000 shares of stock in his margin account. The stock goes up all the following are affected except. Right, and as you notice here, the debit balance isn't affected. You still owe $20,000. Right, so they could actually ask you about the changes in these are called ledger entries. And so my point is, if you're doing ledger entries like this, you got to really be, disciplined and being organized about how you're going about that. Right. So your point, this is what you said, where you were not using that's called mark to market. And if you don't know that mark is based on the current market value, that could certainly mess you up.
Thank you. I really appreciate it.
You're welcome. And then types of orders, there's only two types of orders. They're market orders and limit orders. Now, granted, there are a zillion qualifiers you can add to the order, but at the end of the day, it's either a market order where you want immediate execution at the best available price, or a limit order in which you want your price or better. Now, one thing you can use to mitigate risk to stop a loss is a stop loss order. So, let's say that Apple is at $188. And what are the two stock positions you can have in a stock? What are the two positions you can have in a stock?
Long or short?
Right on, right on. So let's say that you buy 1,000 shares of Apple at 188. I say, Lindsay, how much are you willing to lose approximately in this investment? You said, well, geez, Dean, why are you sending out negative vibes like that? And I said, well, Lindsay, part of successful investing is letting your flowers bloom, but more importantly, pulling the weeds. And so at what point are we going to say this is a bad idea? What I want you to do is stop the loss, stop the bleeding. And you say, well, gee, I think I'd be willing to lose approximately $3,000. I say, okay, well, let's place a sell stop at 185. You're now telling your broker that if Apple trades at or through 185, you want to sell the stock and you want to go home. You want to stop the loss. So what's the other position you can have? Let's just put that where stop a loss and a long position. So what is the other kind of stock position you can have? Short position, right? So if you short Apple, that's really silly. That's really silly to short the Apple. So I say, Lindsay, if you short stock, if you sell stock you don't own, you're exposing yourself to unlimited risk. Lindsay, don't be a dumb bear. Don't be a dumb bear, be a smart bear. How much are you willing to lose before you're going to say that this short position is a bad idea? Because what I'd like to do is place test question, a buy stop to protect you or stop the loss. And buy stop, boom. You would place that. Maybe we say, well, we're willing to lose approximately $4,000. Now you're telling me that if Apple trades at or through 192, you want to go home, And again, what we're trying to do here is stop a loss and a short position. There are other uses of stop orders, but those are the big ones. That's why we call them stop losses. Now, if it trades at or through, we pull the trigger, it's a market order. You want immediate execution at the best available price. But if you want, you can be foolish. Again, don't be a dumb bear, but if you want to be foolish, you could make that a limit order. Say, Dean, when it trades at or through 192, I don't want a market order. I want to be able to buy it for 193 or less. I said, well, Lindsay, let me get this right. Your stop's at 192 and a limit at 193. You say, yep. I go, wow, that is really not smart. You say, why is that not smart? I said, because now if we pull the trigger, you're saying you only want to go home if you can get your price or better. And nobody has to do business with you at your price or better. And so, that's why we use these stop orders. Now, by the way, I'm hinting in this screen that there's a mnemonic or memory aid device that's worth a lot of points. right? You know what that is, or what that mnemonic is?
Slobs over faucet.
Yeah, that's right.
But one thing that I think just clicked um, was if the word stop is in it, you're automatically stopping a loss.
Yeah,
Uh,
well, there's other uses, but that's the primary one. You can use stops. I have a whole lecture on types of orders. You can watch a class replay of me doing this entire for an hour and a half doing this with all these types of orders, or you can watch a lecture. There's two videos on this. But yeah, that's the number one use. But you can also use stop orders to establish a stock position. You can use them to protect a profit. So Lindsay, if we bought the Apple 188, it went to 210. I'd say, well, we don't need to stop a loss. Let's move up our sell stop to protect the profit.
yeah.
But that's the primary use.
Well, I don't know if this is just me, but basically, so what I'm thinking for your example, it would be dumb to short Apple. So that's going to stick in my head because it's BS for a
I
buy.
like that. That's right. Yeah, because remember, shorting stock, selling things you don't own in most businesses is called fraud.
Yeah.
But in our business, you can do that, but you're exposing yourself. Remember, the other thing you can do in risk mitigation besides buy stop is you might want to buy a call.
Yeah.
That would help you protect it too. So there's two risk mitigation strategies for somebody who's short the stock. First is don't be stupid, do something. Don't just short the stock, either buy a call or enter buy stop. And also you could do here, you could buy a put. All right. Well, looks like it's time to call it a night. I will link to this with these lectures, but you can find them as well on your own in the search bar. Moving averages are just to smooth out my chart to make the trend more discernible. So it just shows me a more pretty picture when I do a moving average. And I can use that moving average to tell me what's called relative strength. So, well, I don't have no idea, Erica, where high water mean. I have no idea what that means. It's not testable for sure. So I don't know if that's a past perfect thing. And
High watermark.
high water mark is on a margin account where you don't get SMA till you go past. I don't know what you're asking about technical analysis. You're only going to get a couple questions. They're pretty straightforward. You should know a head and shoulders pattern. You should know the technical analysis under the efficient market hypothesis. Weak form doesn't work. So I don't know what high water mean. Send me the question or the thing and I'll look at it, but I have no idea what that is. All right, moving average is just to smooth out my chart and make the trend more discernible is what that's about. All right, anything else before we call it a night on the overtime session? Did I miss anybody? Don't think so. What is it with this, live stream? We always get the ladies and we get no gentlemen. What's up with that? The gentlemen don't want to join.
Ladies love Dean.
Oh, well, I wish.
We do.
I wish. All right. I will see you next time. Listen, this live stream will be next Tuesday as a replay, and then the following Tuesday will be next live stream. And I will put that up as soon as we hang up. I'll put up the next live stream opportunity. This one we didn't have all 10 people show up, but it was capped at 10. And an office hour tomorrow, Wednesday. That's for people who've paid for either a class or tutoring, and I think that's tomorrow. And I think let me see.
It's tomorrow, Dean.
Is it tomorrow? Let's see who we
Yep.
got. I'm sure Erica's.
That me.
But maybe it's just you and I, Eric. Let's see who's there.
Woohoo!
We have two people. We got Erica and Ray. So Ray, I'll see you and Erica tomorrow. If you have paid for tutoring or a class, that is available to you as well. And that's on the class setup. And I'll add another office hour tonight as well. Any other questions or comments?
Dean, and any other tips as far as using Kaplan for a vendor? Like, what's a good score there?
Well, I think your scores were good. I would want you to be in the mid 70s, but I even think 70 is fine. I think 70 is fine. So I don't think you're a risk this time. As we talked about, you're a worker, so you just got to keep working. And that's grind it out like you did in the past. I think you got another testing victory. I would like you to be in the mid 70s. Just the margin of safety is always better on the higher score. So I don't think you're at risk, but I would ideally the higher the better. But I would like you to routinely be able to get mid 70s.
Okay. Thanks, Dean.
High 70, that would be great too, right? We'll take it. 80s?
Yeah. Abundance, right?
So,
Thanks,
all right.
Dean.
You bet. And then those of you who asked, I will probably put the link in the video description for the videos on types of orders, margins, variable annuities, whatever else we discussed. I'll probably get that done tomorrow. So even though this won't show up as a replay, the links will show up so you can actually find those things. Okay.
You are awesome. Thank you so much,
You bet.
Dean.
You bet. I like your Lindsay, that is that you or is that some
No,
rock
that's
from the 70s?
no, that's me. I'm a spiritual healer on the side.
Oh, wow. Wow. I mean, you look like some kind of a rock star. I'm like, wow.
Thank you.
All right, everybody. I'll see you next time. Bye-bye.
Have a good day.